Hi everybody, this is Alex, and today we're going to be talking about some accounting basics, starting with the accounting equation itself at the top of your video here. So assets equal liabilities plus equity. What does this mean? Everything in accounting comes back to this simple formula. And this formula, this equation, also represents one of the main financial statements known as the balance sheet. But as we'll see, there's also a relationship with the income statement, which is another financial statement. But let's explore these one by one. Let's break it down a little bit. So cash, we all know what cash is. That's an asset. It's going to go on your balance sheet. Accounts receivable, however, it's money that is owed to you because you have provided a service or a good but have not been paid yet. Okay, that's an asset too. Then there's inventory. So if you sell widgets, that counts as an asset as well. It's going to go on your balance sheet as an asset. That's how it's going to be organized. You should think of assets as things that provide some future economic benefit to you. Okay, that's one way of defining them. Moving to the right side of the equation of the equal sign, we have liabilities. And an example of a liability is accounts payable. Accounts payable is the exact opposite of accounts receivable because now, instead of being owed money, you owe the money because you've been provided goods or services and you haven't paid yet. Wages payable, similar. You, the business, you owe your employees wages, but you haven't paid them yet for whatever reason. You accrue, you add up that amount, and eventually when you pay them, you'll get rid of that payable because that liability will no longer be outstanding. Okay. Unearned revenue is another type of liability. This is for a situation in which you actually have been paid, but you haven't performed the work yet, okay, or sold the good. But you've been paid in advance because that's just how the parties have negotiated the relationship. We'll see examples of that in future videos. Then there's equity. Okay, that's the last part. And equity includes retained earnings, which is essentially a summary of net income or net loss that the business has accumulated over the years. And again, you see that reference to net income. That's the relationship with the income statement, which I'll touch on a little more further. So that's retained earnings. Common stock is another big part of equity. Common stock, when businesses issue stock, they keep track of it on the equity side of their balance sheet. Okay, so now let's fully focus on the income statement. This formula, it's simple. Revenue minus expenses equals net income or net loss, right? If the expenses exceed your revenue, obviously that's going to be a loss. On an actual income statement, it's going to have many different types of expenses. This word expense is used generally, but that's the idea, that ultimately you're going to get to some bottom line figure. Net income is also known as profit, right? Assuming you made a profit, or you could have suffered a loss. So, but let's go back now up to the accounting equation, to the balance sheet, and let's talk about this relationship a little more. Notice I point to net income as stemming from equity. Net income, remember, it contributes to equity. It contributes because retained earnings is a part of equity, right? So regardless of whether your net income is positive or negative, right? You have net income, and that's going to feed into your retained earnings, right? Which makes up your equity account. Okay. So let's move on, and now let's actually talk about how do we record business transactions, right? So let's use the example of I'm a business and I have done some work or sold a good and I haven't yet been paid. So we talked about this scenario. Accounts receivable, right, is the account that is relevant because you are owed money. You haven't been paid. You'll be paid in the future. That's an asset. DR stands for debit. CR stands for credit. I'll talk about this in a second. First, I want to set up this scenario to work with. So the credit here is going to be to revenue. And let's say it's $100. So it's revenue because you've done the work, whether that's a service or a good. So you have revenue that's now going to go onto the income statement, which, as we've discussed, is also linked to the balance sheet. So I have those abbreviations there: BS for balance sheet, IS for income statement. So this is called a journal entry. This is sort of your building block for what eventually will become the financial statement. Okay, whether that's the balance sheet, the income statement, and there's some others that we'll talk about in future videos. But this is a journal entry. A lot of journal entries will affect just the balance sheet or just the income statement. But as you can see here, this sort of this business transaction actually affects both. So now let's talk about this DR and CR, because this is very important. And I think the best way to learn this is to look at what is called a T account. Okay, because, so I'm just going to put T account. A T account is a summary of the journal entries, right? Because you could have tons of journal entries and they might affect the same account over and over and over, right? So you want to keep track. So these T accounts are going to be called accounts receivable and revenue, because that's what we're working with right now. Know this, that when you're dealing with T accounts and just in general, debits always go on the left, credits always go on the right. With the journal entry, the debits always go on top, the credits always go on the bottom, okay? Now, the next important thing to talk about, though, is, well, how do we demonstrate an increase or a decrease in an account with the debits and credits, right? Because I haven't actually talked about, well, what's an increase, what's a decrease. I've just said, left, right, debit, credit. So for that, I think we should go back to the accounting equation, okay? This is super important. So I'm going to draw sort of like well, let's see. I just want to make it clear that you should think about the accounting equation as two main chunks. So the left, the assets, for everything that's an asset, if you debit, right, DR, if you debit the account, whether that's cash, accounts receivable, inventory, or something else, if you debit it, that's going to cause the account to increase, okay? If you credit it, it's going to be just the opposite, decrease. So that's one side. The other side, liabilities and equity, you treat those the same, but it's going to be the exact opposite of assets. If you debit a liability or debit equity, that means you're decreasing it overall. If you credit it, that means you are decreasing it. I'm sorry, increasing it. There you go. There's the arrow pointing up. Okay? So let's see how this plays out. Accounts receivable, $100. It's a debit. We know an accounts receivable is an asset, and we've set up here that debit to an asset is an increase. And this makes sense, right? You are increasing your accounts receivable because you are owed money, right? You're increasing your assets overall. You're increasing that part of the accounting equation. Now, what's the other part of this journal entry? It's revenue. Revenue is part of the income statement, but it has a relationship to the balance sheet, which I'm going to talk about in 1 second. But first, notice that here, you're increasing revenue with a credit. So, it's very important not to get these confused. And you should always be able to balance. So obviously the journal entry balance is here because your debits are 100 and your credits are 100. So that checks out, right? Your debits should always equal your credits. So debits must equal credits in any given journal entry. Accounting's fun that way. But it also must balance in terms of the overall equation. And surely here it does. Because back to assets equals liabilities plus equity, you have assets going up by 100. And, as I'll talk about more in one sec, equity goes up by 100. Okay, but this is the accounting equation and it represents the balance sheet. So how does revenue fit in with that, right? Because revenue is on the income statement. So let's talk about that just to make it crystal clear. We know that equity, just like liabilities, is increased with a credit, right? So however that amount increases, whether it's through retained earnings, which remember is increased or decreased by net income, or it's common stock or something else, equity goes up with a credit and it goes down with a debit. So if revenue overall increases equity, well then it would only make sense that revenue is credited to increase it and debited to decrease it. So if you're crediting revenue, you're increasing it, and so it's going in the same direction as equity, right? The more revenue, the higher net income, the higher your retained earnings, the higher your overall equity. That's what this is representing here that I just circled. Okay, and expenses are just going to be the exact opposite, right? You debit the expenses, they go up. If you credit expenses, you're decreasing your expenses, they go down. And that makes sense because with expenses, right, if I'm debiting expenses for 100, for example, that net effect is going to be to decrease equity, right? And so, but how do you decrease equity? Also with a debit. So that's a little bit tricky, but just make sure to be really careful with that, to keep your debits and your credits straight, and you shouldn't run into any problems. So I think that's all for now. This is an introductory lesson to accounting. If you found this video helpful, please like and subscribe to my account, and I'll be talking to you soon again. Thank you.